buying tops, selling bottoms, FOMOing into coins, putting a million indicators and lines all over our charts to try and confirm a bias that's usually wrong. But how do we avoid these things, and what are some of the Jedi mind tricks we can employ to make this our most profitable trading year ever? It's not as hard as you think, and at the Defy Edge has just broken it down on Twitter for you in this killer thread. Stick around as we dive right in. Good evening, Tex here reporting for duty. As I said, at the Defy Edge has just posted this killer Twitter thread on 14 of the most detrimental types of cognitive biases. And you go, oh, 14, it's such a long... No, it's not really. It's pretty simple, and I can guarantee you I'm guilty of it, and I'm sure you probably are, of 90% of these mental mistakes that we made. And I mentioned a few before in the intro there. FOMOing into coins, reading news articles and immediately buying or selling a coin based on one train of thought only, putting a million indicators on your charts and then lines, and God knows what, that ends up looking like a Jackson Pollock by the time that you're done charting Bitcoin. I've been there. I've done that. And it took a long time for me to mentally get away from those types of habits that were really detrimental to my trades. And that's where UTG, I guess, is well known for really simplifying the way in which we trade, sticking with a type of trading strategy that works, that we share all for free, of course, inside our Discord. Hit the links below if you want to come in. The first time in 4 months that we have opened up our Discord, and of course, unitytradinggroup.com. So, as I said, at the Defy Edge, I'll give this boy credit where it is well and truly due. He said, I've studied hundreds of cognitive biases to become a better crypto investor. Here are the 14 most important ones. And I also have a couple of little handy tools for you as well that relate to this too. So he said, have you ever FOMO'd into a coin at all-time highs? Guilty. Sell your blue chips for shit coins? Guilty. Lose 50% on a coin and lose another 45% because you didn't cut your losses? Hella guilty. That's cognitive biases working against you. They're thinking errors, aka bugs in your brain. And he's exactly right. A cognitive bias is just using the environment and things around you to make a decision rather than being thought out, rational, and abiding by what you believe is right, not letting everything else get inside your head to make a decision. Of course, in crypto, some things can be FOMO'd into that are profitable. Look at SHIB, for example, last year when we're going on the back of the TikTok trends, and you look at certain NFTs, for example, that are booming on the back of a tweet. Elon Musk, when he was tweeting about Doge back in the day when that was still having an influence on the coin. Those are all types of things that we let get to us that 99.9% of the time are wrong or incorrect to follow, and the 1% of the time, which is very, very rare, they're correct and they can end up making you a lot of money. But 90% of the time, as I said, you want to stay away from these types of detrimental cognitive biases because they are killing your profits. So let's go through number one, unit bias. So people prefer to buy a whole unit of a token rather than a fraction of it. It's why meme coins exploded. Don't overweigh the value of a token because it is cheap. Understanding how market caps work. So let's dive into this. So he talks about shitcoin A, price per coin 0.02 cents, 250,000 units equals 5 grand. Where you can buy an Ethereum for 3 grand and have 1.67 units at 5 grand. And what it's showing you is the value of a coin 1 year later when you've FOMO'd into a shit coin that has lost 50% of its value, and you're now left with a total of $1,250 remaining, a net loss of $3,750. Or you simply could have just stuck with a high cap coin. That is lesson number one in this. If you are not an experienced trader, stay away from low market cap coins. I'm talking about the SHIBs of the world, the APRAs of the world, the wealths of the world. These coins are not for inexperienced traders to play in. And I've shared inside the Discord a couple of times where this year I'm a little bit more inclined to throw a couple $100 into these, very low market cap coins that I am happy to lose. If I lose $100 in the market, or a few $100 spread across a couple of coins, that's the risk that we play. That's the cost of our tuition. And sometimes you can get lucky with these coins. Again, using the example of SHIB last year. I had $1,000 in SHIB, I sold out, and then it did those crazy runs, and I would have made tens of millions of dollars. It is what it is. But for myself, as someone who primarily trades Ethereum and the high cap coins, I'm far more inclined to be happy in my position of Ethereum. If it loses a few $100 value, it is the way that it is. But if I'm in shitcoin A and it loses 50, 60, 70% of its value very quickly, which it can often do when people pull out of their low cap market coins to put back into the high caps, you're ruined. And if you're over leveraged, if you're putting too much money into this market, you are going to thrash yourself. It's as simple as that. Number 2, anchoring bias, over-reliance on the first piece of information you have. That could be a tweet, that could be a news article, it could be a friend in your ear who thinks he knows what they're doing, telling you to buy XRP, which would have worked well the last couple of days, but in general, I'm using XRP as an example. Don't bash me. I've traded that plenty of times. But, you know, you heard about Bitcoin at $1,000. You missed out. It goes up to $5,000. You don't want to buy it anymore because it's too expensive in your head. Evaluate it based on its potential, not its past. What upside potential does a coin have? Rather than looking about Ethereum, for example, recently bottoming out at $2,100 and now being at $3,200, we look about Ethereum at $4,300, $4,400, $5,000, $6,000, $7,000, $10,000 in the future. So I'm looking at upside potential and not worrying about the previous coin history. Of course, that is important, but 9 times out of 10, I'm looking for upside potential. I'm looking left. I'm looking at what the coin has done in the past. I'm not concerned about it being a few $100s less when I should have jumped into it and it's now too expensive. That one alone will kill you. I can assure you of that. Confirmation bias. You only seek out information that tells you what you want to hear. So guilty of this. You only follow people that say good things about X coin. You unfollow and block anyone that spreads FUD. When you invest, seek and research the FUD to see if it's valid. And you know, when you hear these things like celebrities, for example, they get so many great pieces of positive information on a movie or a song or whatever it is, but it's the one negative comment that sticks in their brain. When you are going against the grain and looking for something that is against what you believe, you focus on the negative, you follow it, and then you make a decision based off of that. Don't do that. Be rational. Look at all people in the market. That's why when on Twitter, I only follow a small amount of people that all have opposing views at times, but all make rational, well thought out information as to why they believe a certain thing is likely to occur. Sunk cost bias, a cost that has occurred and can't be recovered. We have a tendency to keep investing more money or overcommitting because we're scared of losing our initial investment. Very, very true. And he's put this sunk cost fallacy image here as well. This person here saying, let's get out of here. This is the worst movie I've ever seen. And this person saying, I think I'd rather stick it out. These tickets cost me an arm and a leg. So true. You know, I think this is where you add to winners and you cut losses quick. The same can be said in life. Double down on things that work for you. Double things that bring you joy or bring you money. And cut the things that are detrimental to your life. People, jobs, habits. Sunk cost in real life. He gives an example. He invested 10K in a friend's frozen yogurt shop. It's doing horrible. I need another 5K for the milk machine, your friend says. You might be tempted to invest more to save your 10K. Don't throw good money after the bad. Rather than throwing another $5,000 in for something that's very horribly down to try and save your dollars, walk away. Very, very easy thing to do. Sunk cost in crypto, you're down 70% of a coin, still have 30% left, that's 70% gone. That 30% could be better off investing somewhere else rather than hoping the original investment bounces back. Man, as I've read this a few times now, and as I read through this again, I go, far out, this is so true. All right, loss aversion. Losing money feels worse than gaining money. Anyone that's been in Vegas knows what I'm talking about. Winning $100 does not feel the same as losing $100. Losing is painful. A study shows that the brain typically assigns 2.5x to a loss. So that plus $250 equals minus $100. And this is so true. Like, I'm just going to break away for a second here. Really, in all things in life, we're going towards things that bring us pleasure, or we're resisting and going away from things that bring us pain or that we fear. And this is so true in crypto. And one thing that I'll tell you is that if you make a loss in this market and you're trying to revenge trade to get it back, or you're scared of jumping into another trade. I did this for a very long time where I was on a pretty horrible losing streak going back a number of years ago, and I still lose, don't get me wrong, but going back a number of years ago where I was losing constantly, and that was going back to what I had, these cognitive biases where I was listening to other people, I was putting a million indicators on my chart, a million types of lines and horizontals and you name it, I had it on my chart, all trying to confirm what I thought was true in that particular instance that wasn't. It wasn't until I started journaling and having a strict trade plan that when I made a loss, I would journal about it, understand exactly where it went wrong, and adapt my strategy based on that error. However, if I was part of a trade plan and I stuck to all my rules and the trade went wrong, that's okay. I learned from that loss. If there's nothing that I can identify that went wrong, perhaps it was a bit of fundamental information, perhaps a whale sold out, perhaps there was some sort of FUD or something getting around that made that coin less desirable at that particular time. I'm okay with that because I stuck to my plan. So the theme of this is have a plan, journal it, understand where you went wrong, deconstruct the losing trade, deconstruct winning trades, and that way you understand the steps that you need to take in future for those trades to be more profitable. Let's get into it. UnityTradingGroup.com. Hit that subscribe button, by the way. Turn on those notifications and we'll get more videos like this as we pump them out week after week. So here's another one as well. An example is when your investment is down 50% and there's more bad news. You can close the trade and cut your losses. And loss aversion means some people will prefer to wait it out. They're afraid of losing the money by selling. One thing that I could say, which would be maybe opposite or opposing to this, is that if you're in an Ethereum or a Bitcoin position and you've got a coin with 10 years of history, where you are probably more inclined as a beginner trader, or perhaps even as a more experienced trader, to simply ride it out. We know the dips are bought up eventually, and that each year after year, we have seen higher prices in Ethereum and Bitcoin than the year previous. So if we're in an instance like this, where we've come down from that almost 70K level, we're down at 30K, and you're still holding. If you've held it for that long, you're probably better off just holding it. In Bitcoin and Ethereum's case, that is, not in low market cap coins, because you should chop that the second that things look like they're going south, because you'll regret it otherwise. So loss aversion leading to risk avoidance. There's been a handful of rugs in DeFi. I've seen how some people vow to never invest in DeFi again. Their loss aversion means they'll be missing out on life-changing gains. That goes back to what I said a moment ago. Don't be afraid of your losses. Learn from them and they become lessons. A recency bias. We overweight recent information and events. ETH price is boring. I'm going to chase after low cap coins. Don't do that. Then they get wrecked in bear markets. You can beat recency bias by zooming out on the charts. Hallelujah! This is so damn true. For most traders, look left or zoom out. Look at the bigger picture. Of course, there's so many coins there that are at zero that have recent price action history. But, example, I'm looking at Ethereum. I'm looking at Bitcoin. Look left, man. Look at the log charts. Look how beautiful the appreciation of this asset has been over the last 10 years. Every single time Bitcoin falls a few K, Bitcoin's dead. Every time Ethereum falls, Ethereum's dead. It's such a detrimental mindset to have to you that is, as I said so many times, is killing your gains. You can make some very simple mental changes, cognitive changes that can all be evaluated rationally with a little bit of thought and change with a little bit of action that can avoid all of these issues. Mentally, we get into our own heads and we get very mentally overwhelmed by our own biases. And they are a killer of your profits, man. I swear to you, I've seen this so many times, and Ads and I have traded, have mentored so many people that have these exact same cognitive biases that are very, very hard to shake, mind you. Don't get me wrong, they are very, very hard to shake. But once you do and you look back at it in hindsight, you go, man, I was a fool for that. I was a fool for that. Right, next, let's get into this overconfidence bias. We've all been there. And when I spoke to Zoran Cole on the Trade Hacker podcast, he said that statistically, the more wins that you have, the closer you are to a loss. And when you are on a hot winning streak, understand that the losses are going to come, but you need to step back after each win, and like I said, evaluate it. Don't let it go to your head. If you get arrogant and cocky, you're done. So we overestimate our own abilities. We get lucky a few times and we think we're smarter than we really are. Very, very true. The key to beating overconfidence is solid risk management strategies. And in this as well, he shares everything you need to know about risk management in crypto. I highly advise you read that thread. It's brilliant. This guy is brilliant. The endowment effect. You become emotionally attached to your bags. So true here. Man, so true. We place a higher value on an investment because we own it. I see this a lot with ETH maxis. I'm probably guilty of this at some times. Don't get me wrong. I'm probably guilty of this as an ETH maxi, 100%. They made great gains with it. They become emotionally attached. They ignore all the other L1s. The Sols of the world, the Lunas of the world, the AVAXs of the world. You're too focused on a coin because Doge made you a couple of K, and you're ignoring the fact that Sol went from 300 to 250 bucks like that in a number of months, and you could have made life-changing money. AVAX was the same. Don't get emotionally attached to your bags. You need to be so emotionally removed from this market And the money that you see in your crypto account should be completely separate to what you believe you own in real life. That could be gone at any time. It's digital internet money until you cash it out and you hold that physical cash in your hand. So think about it like that. That's your tuition. If you lose, it's the cost of playing the game. How to beat the endowment effect. Zero-based decision making. If I didn't own this investment, would I invest in it today? This keeps your decision more neutral. Again, it comes down to a plan. Plan. Survivorship bias. Brad Pitt moved to LA and was a waiter before becoming a movie star. Many people have followed his path hoping to do the same. You don't hear about the thousands of people who have tried the same and failed. And here's your survivorship bias. The 0.1% who succeed. If I can do it, anyone can. The 99% who failed. The fantastic thing about cryptocurrency, even though it's a young, very young market, or anything in that life, is that people have written about it and showed you the way that they do it. Does that mean that you're going to make it? No, it doesn't. But does that mean you've got a far better chance if you study these people and understand their relationships with their markets, how they think, than someone who's just aping into anything and being very emotionally attached to their trading? Yes, you will have a far better chance of doing that. There's always someone better than you, and there's always someone better than you that's written about it and shared their experiences. Go find those people and learn. Someone turned $8,000 into Shiba Inu into $5.7 billion. Yeah, I had $1,000 in SHIB. I sold that. I wouldn't be here making these videos, I tell you that. I love you. You don't hear about the thousands of others who turned $8K into $500. We've all been there and done that. The media prefers writing about the winners, and this skews your perception of the odds. Plot twist, I am Brad Pitt. Funny. So, you know, at the same time, you know, you hear about someone's success and you think, oh, they're the only people who can do that, or, you know, the media always writes about negativity, so you believe all there is negativity, but there's some beautiful things out there in the world that the media just choose not to write about. The same thing is said here in any market, really any place in the world or any market. A narrative bias. Humans love stories. It helps us make sense of the world. Some coins explode because of the story. Absolutely they do. Remember GameStop last year? I do. That was a story about the little guy defeating the big guy and smashing them. It was revolution against Wall Street. People invested because of the narrative. People invest in stories. People invest in hope. If you can find coins that give that hope or that narrative, then maybe on the odd occasion where you can afford to either be in it or emotionally remove yourself from the trade, you'll make some money, but 9 times out of 10 you won't. The herd mentality bias. Investors' tendency to follow and copy what others are doing, a la TikTok. They are largely influenced by emotion and instinct rather than by their own independent analysis. If you've ever felt the FOMO, it could be because of herd mentality. 100%. I've felt FOMO so many times before, and I've traded based on FOMO and gotten wrecked 8 out of 10 times. 12. The availability heuristic. You make judgments based on how easy it is to remember information. After major airplane crashes, there's usually a fear of flying. However, 1 in 9,821 people die in a plane crash. 1 out of 114 die in a car accident. Planes are much safer. Just like getting attacked by a shark or getting struck by lightning. People think it's going to happen to them. More often than not, it won't. In crypto, the availability bias presents itself in marketing. A coin might be pumping because it has great marketing. Marketing is important, but make sure that it isn't masking a terrible project. And here's some information here. The heuristic here, easy to recall, hard to recall, can lead to plane crashes, safe flights, fear of flying, cold spell, gradual warming, ignoring climate change. Winning tickets, hard to recall, normal tickets, can lead to buying more at the expense of things that may be more common but don't easily come to mind. Very, very true. As we get down towards the end of it, stick around. Outcome bias. Outcome bias is an error made in evaluating the quality of a decision when the outcome of that decision is already known. So I'll say that again. Outcome bias. Outcome bias is an error made in evaluating the quality of a decision when the outcome of that decision is already known. That's always in the back of your brain. Whether you know it or not, it's always in the back of your brain. Imagine going all in with AA versus JJ in poker and losing. You made a great decision, but it led to bad outcomes. AA has an 80% chance of winning in this case. That's you invest 10K into a shitcoin that's now worth 100K. That had a great outcome, but was a poor decision. That's powerful stuff, man. That is really powerful stuff, bro. Another angle of outcome bias. Imagine if this scenario was replayed 1,000 times. You have to account for variance. You can do everything right and the outcome still won't be right. That's life. But probably you should always make the decision with the best odds and the best probability. Last one. Authority bias. This is our natural tendency to follow the leader. Once we believe someone is an expert, we trust everything they say. They're the expert, I must be right. Experts can be wrong. Experts can have ulterior motives. Think about the people that were bashing the internet. There was a very famous analyst or a financier, I believe, going back many decades ago that said the internet was just a fad. He could not be more wrong. Peter Schiff thinks that Bitcoin is horrible and gold's the way. He could not be any more wrong. There are people that have authority, are respected leaders in this market that just tend to be wrong, or could be wrong at times. Not everyone, but certainly don't follow someone because you believe that they are the key authority in something without doing your own decision, or making your own decision rather. So here we get into some actionable steps here. How do you stop cognitive bias? Well, you're already doing a great job, at least you're aware of them. Here are some strategies that I use to lower the damage of cognitive bias. 1, call them out. My friend bought $100 non-refundable tickets to see a show. He had a chance to do a consulting gig that night for $500. He didn't want to lose the $100 he spent. I told him that the sunk cost bias was affecting his decision making. 100%. How many times have we done that before? Developing a cognitive bias checklist. Whenever I'm making an investment decision, I go through my cognitive biases checklist. This keeps me aware of my own thinking flaws. Again, it comes down to a plan. If you need to write this out, stick it on your wall, and go through those steps every single time that you make a buying decision in anything in life, you should evaluate it before doing so, especially when you're trading with serious money. That's when your mind really starts to play tricks on you, especially when your wallet is down. Consider creating your own systems for investing. Formulas can help keep emotions in check. Here's an example. Systems over emotions. Example, take 40% profit when the Degen coin has 2x'd. Buy ETH with fiat on the 1st of every month. No coin can be bigger than 15% of my portfolio. Degen coins max 5% of my portfolio. Must wait 3 days before purchasing a coin. Stops FOMO. Do you have any systems that you use? And this is a great thread. There'll be a lot of people there sharing information, so check it out. So keep a trading log. Hallelujah. I keep a Google spreadsheet that contains all my trades. Besides the financial data, I also write about some of my thesis. If I exited early, I will write down any issues I faced. By the way, it's in my plans for me to create a free template for you. Thank you. So as he says, and I'll just go back to this. If people are watching this far, let me know. I have a free trading log that we charge $20 for on our website that I will give to you for free if you have made it this far. Like this video and leave a comment below saying I want my trade journal, and I will share it with you personally. So next, use cognitive biases to your advantage. Understanding cognitive biases means you can profit from others. A coin that has a good narrative, a charismatic leader, marketing, availability bias, plus herd mentality, the more cultish, the more profit potential, 100%. And look at NFTs in this space. That's cult-like mentality. We have so many people that believe that DeFi is the future, NFTs are the future, which I believe so also, but that gets to like a cult-style mentality where people are all for this, they're all in, nothing else matters, this is all that matters to them, and the people that are touting it, the authorities in the space, are the gods to be listening to. So there you go. Those are some of the cognitive biases that are stripping you of potential profits. 2022 is going to be a hard year, bro. I'm not going to lie to you. It's going to be a hard year. There's going to be some times that we are massively down. There are going to be more times that we are massively up. But we need to keep our emotions in check the whole time. Stick with the trade plan and deconstruct every single trade that you make to understand where you went right, or more importantly, where you went wrong, so you can learn from it and turn it into a lesson. I am Tex. As I said, leave your comments below. Hit that subscribe button. Turn on notifications because there's lots more content coming like this. And head to UdiniTradingGroup.com. Thank you so much for being a part of this. I appreciate you. Take care, and more importantly, trade safe. Bye.